Well, welcome back. The stock market has been on a roller coaster in the first half of this year. Now, for some younger investors, this volatility might not be life-changing, but for those approaching retirement or already living on investments, it could be a little more uneasy. To talk more about that this morning is our financial advisor, Bruce Allen of Bruce G. Allen Investments. Good to see you again.
You too.
All right. So older investors, what can they do to protect themselves?
So as investors are transitioning from earning an income to living on their investments or are already in that process, many advisors take a look at how can they help protect their clients or insulate them from market volatility by creating what they call a reserve fund. And the reserve fund is invested very differently than the rest of the money that's needed to grow for the rest of their life. And this is just a sample. So many investors say, okay, how much money am I going to need to withdraw from my investments? I want to set this money aside in a reserve fund for 5 years or 7 years or 10 years, however long. And that money should be invested differently than the money that's going to need to help protect them from not running out of money in retirement.
Little more conservative investments. Yeah. So how do you determine how much money you need in a reserve fund?
Great question. So typically advisors will start by saying, hey, help us by creating a budget. How much do you need to withdraw from your investments over per year, and have an annual budget of expenses that the investments will need to cover? And then typically, a lot of advisors will recommend between 5 and 10 years. And the reason for that is if you set aside 5 years of the income that you're going to need and set that aside in very conservative investments, that typically is the longest time that a market will fall and take to recover. So, for example, if you set aside a 5-year reserve fund, you've protected yourself against a very severe market decline, potentially. And some people say, well, I'd like 7 years or 10 years. But either way, that money is invested to provide for those expenses, and it's not as subject to the same kind of volatility as stocks. The whole goal is to ensure and protect those clients and insulate them from market volatility by creating this kind of fund.
Sure. And what kind of investing should we be doing in this reserve fund?
Typically, and again, this is just our off the cuff kind of thoughts, but typically short-term treasuries, short-term CDs, very conservative bonds, high-quality tax-exempt municipal bonds. Those are candidates that we look at for our clients who are trying to accomplish this. But each person's conditions different. The good news, Gary, is that rates are probably going to go up by a full percentage point over the next 60 days. So people who are implementing this strategy right now will be able to take a look at higher treasury rates 60 days from now than they are today. They're going to be a full percentage point higher, likely. That's the best guess.
And we ask you this all the time because you do have that crystal ball. What do you think the market's going to do the rest of the year? Are we going to see this continue?
I think there's two things. One is, how is the economic data going to pan out? And as President Eisenhower said once, I'd like a one-handed economist, because they say on the one hand versus the other hand. But having said that, I think the critical issue is how well is the Federal Reserve going to manage through this inflation? And are we going to see inflation calm down a little bit? Or is it going to continue to be very, is inflation going to stay a problem? If it calms down, the stock market will likely like that. So we are somewhat hostage to how is the economy going to do. The second piece of this is that stocks that have done this poorly this part of the year, so stocks that have gone down this much through May, they have not had a great track record, history suggests. So investors need to be somewhat cautious as we go through the rest of this year. Finally, the stock market hates midterm elections. It doesn't matter what party you are. Either way, after the election's over, things get better. So we'll see how this unfolds, but there's a lot of question marks right now.
Yep. All right. Bruce Allen, as always, thank you. It's good to see you.
You too.
Okay. Take care.
Take care.